Notes receivable and payable. We'll learn about notes receivable and payable. They are very similar to one another. They're the same sets of transactions on either company's books. They are just named other things, but the calculation is the same. One company will have a note receivable and one company will have a note payable. Let's look at a $20,000 note. It's a 90-day note and it's going to have an interest component at 9%, 9% annual interest. So a note receivable would more likely be consummated by the bank. The bank would have a notes receivable and the company who borrows the money will have a notes payable. We can see that the entries are very similar. The bank has a note receivable for $20,000 and it paid to the company $20,000. The company received $20,000 and now it has a note payable in the amount of $20,000. The bank will receive the loan amount back, the $20,000 plus the interest over the 90 days, and the company will pay the loan amount back plus the interest. So let's look at the calculation of interest. Interest calculation and the total amount due. The company will pay back the face value of the note, the $20,000, plus interest. So let's look at how we calculate interest. This is the face value, 9%. Any interest associated with the note is always assumed to be an annual interest rate. So we will take 20,000, multiply it by 9%, and the annual interest for this loan was $1,800. However, it's only been taken out for 90 days. In order to convert it to a daily rate and be able to look at interest for each day in the 90 days, we have to divide the total annual interest by the number of days in the year. There is a convention that is used for all notes where it is called a banker's year in days, where every month in the year, all 12 months, are looked at equally as being 30 days, having 30 days. So it'll be 360 days, so that will be 12 months times 30 days per month. So the banker's year in days is 360. So the annual interest will always be divided by 360. This will yield a daily interest rate, which we want to multiply by 90 days because that's the number of days the loan is outstanding. So the total interest on the note associated with this note is $450. So the company will be paying back $20,000 plus the interest, will be paying back a total of $20,450, and the bank will be receiving $20,450. So when the loan is paid off, the journal entry for the bank will be it will receive cash in the amount of $20,450. It will no longer have the note receivable in the amount of $20,000, and it will have earned interest revenue in the amount of $450. The journal entry for the company would be the note payable would have been paid off, so it will be debited. It was previously credited. They will recognize interest expense in the amount of $450, and the cash they are paying back is $20,450. Now, let's look at a little bit more of a complicated scenario when financial statements are prepared between the loan date and the due date. So here we have the same calculation from the other page, but in this instance, financial statements are prepared 20 days after the loan was consummated. Now, we learned when we did adjusting journal entries that we have to bring all of the amounts in the general ledger up to date so that they will be correctly stated on the financial statement date. So therefore, since we have to accrue for and take into consideration 20 days that have transpired between the date we took out the note and the date the financial statements are being prepared, we will have to calculate that amount for 20 days. So the interest revenue for the bank and the interest expense for the company for the financial statement date will be the daily interest of $5 times the number of days that has been outstanding between the time of the consummation of the note and the date the financial statements are prepared. So the interest revenue recognized by the bank will be $100 and the interest expense recognized by the company will be $100. Now, let's look at the bank's books. It will have an interest receivable because it's not going to receive this $100 until the loan is actually due in another 70 days. So we have 20 days from the date it was consummated, the date the financial statements, and then there's another 70 days after the date of the financial statement to the date the note will be paid back. So they will have an interest receivable of $100, but they get to recognize interest revenue in the amount of $100. Now, this is a very valid transaction because they have a contract and a legal document between themselves and the company. So legally, they would be able to recognize this interest revenue as time has gone by. Now, let's look what's happening on the company's bank. It will have an interest expense associated with the loan and then an interest payable. So this will be a portion of what they'll be paying back in 70 days from now after the financial statements are prepared when they pay off the loan. So now let's look at the next period, the interest and the revenue. The daily interest remains the same, but now we have 70 days associated with the time after the financial statements are prepared, but before and until the time the loan will be paid back. So that interest revenue component will be $350. So we can look at it in total. We still have 5 days as a daily interest, 20 and 70 with 90 days in total. Our total interest or revenue is $450. It's just been broken up because of the artificial date imposed by the financial statements. So $100 in one period and $350 in the next period. So what happens when the bank finally is paid off? Well, it will recognize the fact that it's getting cash in the amount of $20,450. It no longer has the note receivable in the amount of $20,000. The interest receivable that they no longer have because now the note has been totally paid off. So this interest receivable from the prior period where it was debited and for the financial statement date, now that it's been paid, it will be credited. So it'll be zeroed out. And they will recognize interest revenue associated with the date between the financial statement date and the date the loan was paid. The company will have a similar set of entries, just named different things because it's a different type of transaction for the company. It will no longer have the note payable. It will no longer have the interest payable. So the interest payable was originally credited. Now we're debiting it and zeroing out. It will recognize the interest expense for this period, and it will be paying out cash in the amount of $20,450.